Welcome to the latest episode of our European Regulatory Update. I'm recording this one from the floor of the New York Stock Exchange. As you know, NYSE Euronext operates the stock markets of New York, Paris, Amsterdam, Brussels, and Lisbon, and of course, the International Futures Exchange Life in London. Legislators and regulators on both sides of the Atlantic are still trying to deal with the causes of the financial crisis and to regulate so that we don't have another such crisis, at least not for the same reasons. You'll be very familiar with the DoddFrank Act, which is now going through the Securities and Exchange Commission and the CFTC for the actual implementation of the rules. Over in Europe, we are still legislating the new MiFID and MiFIR legislation, which deals with market structure and transparency requirements for all asset classes, equities, derivatives, and bonds. There are some differences, however, with regards to the approach on both sides of the Atlantic. And as a major market operator, we really call on legislators to try and cooperate as much as possible so that there's no room for regulatory arbitrage with regards to the implementation of the rules. And as I speak, members of the Econ Committee of the European Parliament are visiting Washington, D.C. to try and hammer out some agreement on many of these complex issues. The re-regulation of financial markets 4 years after the beginning of the crisis is taking place against a continued backdrop of, I would say, corruption and mismanagement in certain areas of financial markets, particularly in the banking sector. So it is extremely difficult for regulators to try and find exactly the right level of rules and regulation. Nonetheless, with MiFID, we seem to be moving in the right direction. One area where we are very concerned is with the creation of OTFs, these organized trading facilities for non-equities, which will allow new entrants to the market, mostly probably the same banks that own and operate the MTFs, to conduct trading in derivatives on a discretionary and in a discriminatory basis. And this is something that the European Parliament really needs to fix before it finalizes its position on MiFID after the summer. The swap execution facilities in the United States, also broker-dealer platforms for the trading of derivatives that are being brought over the counter into the regulated space, do not have this discretionary and discriminatory characterization. A second major flashpoint in Europe is the insistence of some to try and permit banks to continue to trade on own account, proprietary trading. It is puzzling to us, against the backdrop of scandals such as the LIBOR scandal, how politicians can allow banks to continue to internalize and to make bets with their capital and indeed the capital of their customers. So you should take a close look at how the European Parliament treats the proprietary trading issue later this year. Transparency really has to be the core issue of re-regulation on both sides of the Atlantic. The major currency for capital markets is not the dollar, it's not the Swiss franc, it's not the euro. The major currency is a currency of trust, and as I said, in the context of continued scandals, it is a lack of trust that is keeping investors, large and small, and also issuing companies away from the marketplace. This is something that US regulators and European regulators need to try and address. Another area which is causing controversy in the European Union is the insistence of the European Commission and some member states to bring full open access to clearing of derivatives instruments. Under the EMIR legislation, the legislators believed that this issue was too complex and too dangerous to allow them to take a decision, so they called for further study. And the European Securities Markets Authority is due to report back on that at the end of 2014. Nonetheless, the European Commission saw fit to include in Articles 28 and 29 of MiFIR full open access, interoperability, cross-margining and fungibility of derivatives products across the European Union, basically allowing any clearinghouse to connect with any trading venue and vice versa. We think that this contains such danger from a systemic perspective that the European Parliament really needs to push for the deletion of these provisions. Interoperability in the clearing of derivatives instruments in the European Union is untested, is risky, and in the current financial crisis, we believe it would be wrong for legislators to go down this path. The main issue here is to make sure that US legislators and regulators and their counterparts in the European Union make sure that the regulation that they put forward is balanced, introduces more transparency across all asset classes and tries to correct some of the major problems with market structure that have resulted from Reg NMS here in the United States and MiFID I in the European Union. We're confident that dialogue is happening. It needs to be intensified, it needs to be more regular, hopefully to avoid arbitrage, as I said, between the two jurisdictions. Thanks for watching.